OG John AG here. Quick heads up for the new people. There are imposters copying this channel. Same format, same style, trying to sell you nonsense. Courses, memberships, signals. Not me. Never been me. Report it, ignore it, move on. This channel sells nothing. Never has, never will. Just raw data and analysis. Drop OG John AG in the comments so I know you're actually paying attention. Or drop any question and I'll get to it. I read everything, here and on X. Both. I appreciate you sharing things for me to discuss. Every comment, every email. I read it. If it matters, we cover it. Now, let's get into it, because Sunday evening before a Monday open is exactly when the signals matter most. Mexico is in crisis, not the kind of slow burn crisis that takes months to develop, the kind that moves fast, military mobilized, airspace shut down in parts of the country, flights canceled, and at the center of it, a significant operation that reportedly took out one of the most consequential cartel leaders in the country's recent history. The details are still developing, and I'm not here to speculate on the political dimensions of that. What I am here to do is connect the dots that the financial media will not connect for you. Mexico is the world's single largest silver-producing country. Roughly 1 in every 4 ounces of silver mined globally comes from Mexican soil. That's not a fun fact. That's a structural reality that makes any significant disruption in that country a direct input into global silver supply. Road blockades, logistics delays, airspace restrictions. None of this creates an instant collapse of supply. That's not how mining works. But here's what matters. This market is already structurally tight. We covered last video how speculative long positioning in silver was sitting near 20-year lows, even as price made aggressive moves. We covered the Shanghai premium already signaling physical demand running ahead of paper. An already tight physical market does not need a full supply collapse to reprice. It needs uncertainty. And right now, uncertainty is exactly what Mexico is generating in real time. Silver is not priced for supply shocks. The paper price at $84 reflects a market that assumes supply continues flowing normally from the world's largest producer. Physical first, paper later. That sequencing matters, and the ones who understand how commodity markets actually respond to supply disruptions understand why this headline deserves more attention than it's getting. Now let me bring in the gold-backed crypto signal, because this directly answers the question a lot of people woke up asking today. PAXG, the gold-backed token that trades 1-to-1 with physical gold, is currently showing a $50 premium above Friday's Western closing price. Gold Western Spot closed the week around $5,098. The token is pricing above that right now, on a Sunday, before Western markets have opened. What does that tell us? Crypto markets trade around the clock. Gold-backed tokens like this one essentially function as a real-time proxy for gold sentiment when traditional markets are closed. When you see a $50 premium developing on a Sunday evening before Monday's open, what you're observing is market participants bidding up gold exposure during hours when they can't access futures or spot markets directly. That is a forward signal. It's not a guarantee. Markets gap and fill. Liquidity plays tricks. And one instrument's weekend pricing doesn't write the script for Monday's institutional open. But it is directional information that the informed minority pays attention to while everyone else waits for CNBC to explain what happened after the fact. If gold follows that signal, the level to watch is the previous week's high, specifically the high set on Wednesday the 11th of February, which also represents the prior weekly high. That's the structure gold needs to clear to confirm momentum continuation. Now I want to be very clear about something. This is tape reading education for people who do short-term trading. I am not calling price. I am not giving you a signal. I am showing you the structure as it exists, because understanding how professional traders read price action is part of the financial warfare education this channel exists to provide. One critical context point here that changes how you interpret any Monday move. Shanghai remains closed Monday. It reopens Tuesday. That means liquidity will be lighter than a typical Monday session. Thinner liquidity environments can amplify moves in both directions. A gap up in gold with Shanghai offline could look more dramatic than the underlying demand actually warrants, and a reversal in that context can be equally sharp. The ones who trade short time frames need to hold that in mind. Light liquidity is not confirmation. It's a condition that demands more caution, not less. On silver's structure specifically, the lower time frame picture is still intact as of this recording. The next objective the tape is pointing toward is $86.3, which also happens to line up with a prior weekly high. That's confluence. When a technical level and a structural market memory point a line at the same price, it carries more weight than either one in isolation. Above that, there is a resistance zone spanning from $87.2 to $89. And this is important. That zone is not a ceiling to slowly grind through. If silver enters that range and consolidates, it loses momentum. What needs to happen at that level is decisive force, price moving through it with volume and conviction, not spending time camping inside it. Again, this is tape reading for the people who work shorter time frames. Not a signal, not advice, just the structure as it reads right now. Now here's the mid-reveal, the layer that connects all of this to something much larger than a Sunday night premium or a Mexican airspace closure. We talked last video about the dollar's share of global reserves hitting its lowest level in 32 years. Central bank gold holdings now exceeding treasuries for the first time since the mid-90s. And the COMEX delivery situation that's been developing quietly in the background. Let me add to that now. With 4 days left before last notice on the February gold contract, the remaining open interest represents over 436,000 ounces, roughly 13.5 tons of gold. That is 24 times the average open interest you'd expect to see at this point in a delivery cycle, and more than double the largest prior contract at the same stage. The February open interest is actually larger than the upcoming March contract. That has likely never happened before in recorded history of this market. What that pattern typically signals, for those who've watched COMEX delivery cycles over years, is a short that has been holding these contracts since first notice day, hoping to close the position and instead finding themselves with no exit as liquidity dried up. Volume on Friday was 134 contracts. That is not a liquid market for someone trying to unwind a position of this size. The uncomfortable question that raises is straightforward. Does this short have the physical metal to deliver? If the answer is no, the playbook from prior episodes of this pattern involves one of the major bullion banks stepping in to issue delivery notices in the final days, which creates its own disruption. The physical market is tight. The COMEX structure around the February contract is anomalous, and we are heading into a Monday open where gold-backed crypto is already pricing a $50 premium before Western institutions have even opened their terminals. G. Edward Griffin documented in Creature from Jekyll Island how concentrated short positions in paper gold markets function not just as trades, but as structural tools for price management. He was dismissed as a conspiracy theorist when he wrote it. Since then, we've seen the JP Morgan precious metals settlement, $920 million, September 2020, and documented CFTC enforcement actions that confirmed exactly what he described. The pattern he identified in historical context is not theoretical. It has case numbers. It has settlement figures. It has admission of guilt. And what we're watching in the current February contract open interest anomaly rhymes with every prior instance where a naked short found itself trapped with no physical to deliver and no clean way out. The geopolitical backdrop adds another layer that the financial media is actively choosing not to connect to metals pricing. The situation with Iran has not resolved. It has reclassified. The U.S. has indicated acceptance of Iran's right to maintain uranium enrichment. That sounds like de-escalation. It isn't necessarily. Military assets, significant military assets, have been moving toward the Middle East in numbers not seen since 2003. When you move that kind of hardware toward a region and then accept a diplomatic proposal, you don't automatically retract the hardware. The strike risk has not been eliminated by the negotiation. It may have simply been paused. Markets that are pricing metals at these levels are partly pricing geopolitical tail risks that haven't resolved. They've only moved from front-page news to background noise. And in the background of all of this, a monetary regime shift is quietly accelerating. Since the 1970s, global currency reserves have been anchored to U.S. dollars and treasuries. That structural demand allowed the United States to run persistent deficits while exporting inflation abroad. Foreign buyers absorbed the treasury supply and financed American consumption. The seizure of Russian reserves changed that calculus fundamentally. Countries that once treated dollar reserves as a safe harbor now understand that those reserves can be weaponized. Central bank gold holdings exceeding treasuries for the first time since the 90s is not a coincidence. It is a documented, measurable response to that risk recalculation. And as more central bank demand shifts toward gold instead of treasuries, less of the inflation created by U.S. deficits gets absorbed externally. More of it stays inside the domestic economy. That is not a theory, that is arithmetic. Jim Rickards laid out this exact dynamic in Currency Wars. How the dollar's role as reserve currency allowed the U.S. to effectively tax the rest of the world through seigniorage and inflation export, and how the moment that privilege is seriously challenged, the inflation that was always being created comes home. We are watching that mechanism activate in real time. Now let me give you the honest case against the immediate bull thesis, because intellectual honesty is what separates this channel from every metals hype account you've encountered before. Lighter liquidity on Monday with Shanghai offline is a double-edged condition. If the gap up materializes, it can reverse just as fast in a thin tape. The Mexico situation, while structurally significant for silver supply, has not yet produced a documented, quantifiable reduction in mine output or shipment data. The cartel disruption risk is real, but it's not yet a supply shock. It's a supply shock risk. Markets can discount that risk and then fade it if the situation stabilizes quickly. The February COMEX anomaly, while statistically unprecedented, has produced bailout resolutions in prior episodes without a full market dislocation. The bullion banks have managed similar situations before. That doesn't mean they can manage this one, but dismissing the possibility would be intellectually dishonest. And for all the analyst targets circulating, the ones calling silver to hundreds of dollars, gold to 5 figures, ratios implying silver at prices that would require a complete monetary reset, those projections are based on historical precedent and balance sheet math that is genuinely valid, but valid on time frames that may extend well beyond most people's patience or planning horizon. Howard Marks, in Mastering the Market Cycle, wrote something that should be tattooed above every precious metals trader's screen. Being right about the direction and being right about the timing are two entirely different skills, and confusing them is how people with correct theses still lose money. Here is what this all means, taken together. Mexico has introduced a genuine supply uncertainty into the world's largest silver-producing country at exactly the moment when physical silver is already running a structural deficit, and COMEX registered inventory sits well below the open interest demanding delivery. The gold-backed crypto premium before Monday's open is telling you something directionally, not definitively, and the structure in gold points toward the prior week's high as the first test if that momentum follows through. Silver's tape is intact with 86.3 as the next structural objective, and a resistance zone above that which needs to be cleared decisively rather than slowly absorbed. Shanghai's reopening will be a key moment, the first price discovery from the world's largest physical silver market after a week offline, returning into a landscape where Mexico is unstable. Iran risk has not been eliminated, and the COMEX February contract is in historically anomalous territory. The monetary regime shift isn't a future event to prepare for. The data is showing it happening now. Central bank buying, dollar reserve share at 32-year lows, COMEX delivery stress, a Shanghai premium that's been persistently elevated. This isn't speculation. It's a pattern that the ones who verify sources have been watching build for months. This is financial warfare education, not advice. Verify everything I've shown you. The COMEX delivery data is public. The COT positioning is public. The Shanghai premium is public. The ones who check those primary sources will understand why what's happening right now is not noise. Invest with logic, not hype. OG out and about.